Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. Today, we're going to cover what you need to know from a tax, investing, and financial planning perspective as all our taxes become due here in Canada on April 30th, 2025. And as we get well underway with 2025 in general. Now, as you know, the government makes changes every year in these areas. The implications of these changes can have a pretty substantial impact on how much you pay in taxes, your net worth, and what government benefits you are eligible to get and how much you get. Now, these can easily affect your net worth in the thousands of dollars every single year. So it's definitely in your and my best interest to know about these changes and get a bit of a refresher so that we can all better prepare and also take advantage of any opportunities that arise, like any benefits that we might become eligible for. To help me with this, I have certified financial planners Jason Heath and Paul McVean on the show. Jason is a popular returning guest on the show, definitely one of the more well-known and respected financial planners here in Canada. So it's definitely great to have him back again. Jason has been providing fee-only, advice-only financial planning since 2002, so over 2 decades. He is also a personal finance columnist for the Financial Post, Money Sense, and Canadian Money Saver. He has a Bachelor of Economics degree from York University and holds the Certified Financial Planner designation. In addition to being a certified financial planner, our second guest, Paul McVean, is also a senior tax accountant. He's a CPA, and he's a trust and estate practitioner at TEP. So definitely very knowledgeable, especially on the tax and how to save you tax side of things, where he has over 25 years of experience. Jason and Paul are both fee-only financial planners here in Canada, which means they don't sell any investments. So there isn't that potential conflict of interest that you see a lot of here in Canada where someone calls themselves a financial planner or a financial advisor. You think you're getting a good financial plan and that they have your best interest at heart, but really they are just trying to get you to buy the investments that their firm sells so that they can earn a hefty commission. So none of that here. We're going for purely unbiased financial education in this episode with Jason and Paul. And if you want to speak with Jason, Paul, or someone from their team, you can reach them over at buildwealthcanada.ca/Jason. Jason and his team have been incredible educational contributors to the Build Wealth Canada podcast over multiple years now. Their episodes are consistently some of the most popular on the show. And I did want to give a big thanks to Jason as he has once again agreed to continue giving Build Wealth Canada listeners a discount if you do decide to work with them when it comes to your financial planning, optimizing your taxes, etc. So a big thanks to Jason for that. And that link again to speak to them to see if you are a good fit for each other and to get a discount if you do decide to work together is buildwealthcanada.ca/Jason. That's buildwealthcanada.ca/Jason. And now, let's get into the show. All right, gentlemen, welcome back to the show.
Thank you. Thank you. Thanks to be here.
To kick things off, can you take us through any significant changes and things to keep in mind for 2025 when it comes to investing, taxes, and financial planning in general here in Canada?
We start with the capital gains thing, or do we start with the boring stuff? Capital gains has got all the attention.
TFSA contribution room is not boring, Jason.
Neutral. Neutral.
I get excited every time we just can plow money into that thing. Let's talk about. Oh, sorry, Paul. What were you going to say?
I was just going to say, I think the covering some of the new limits and numbers, we can check that off the list pretty quickly and save some time for the bigger capital gains discussion shortly after.
That sounds good. Yeah. Why don't we start with a positive, like, hey, you have more contribution room piece, and then we can talk about now, and then we can go to capital gains inclusion rate, something which is more negative, right? So yeah, let's start with the positive.
Well,
who wants to begin?
Hey, look, I'll jump in. $7,000 for the new 2025 TFSA limit after 2 years of $500 increases. I think we went from $6,000 to $6,500 to $7,000, and now it's still $7,000 this year. But Basically, if you've not contributed to your TFSA in the past, and if you were at least 18 years of age in 2009 when TFSAs were introduced, so if you're born in 1991 or earlier, you've got 102,000 of cumulative TFSA room. So quite a bit.
Yeah. Yeah, that's a really nice one. I was speaking to someone recently and they thought they were fully contributing because the past few years they did. And then I'm looking at their portfolio and it's like, it's over $100,000 now. So if you have $20,000 sitting in your TFSA, it's probably safe to assume you've got quite a bit of contribution room left and the time to learn about the inner workings of it. Because yeah, it's really, one of my favorite tools for sure when it comes to investing. Yeah, did you want to add anything else?
Yeah, I'll jump in on that. On TFSAs, as a tax guy, I often get asked, what's the best thing we can be doing? And when it comes to investing, you really can't better than totally tax-free. So certainly I think tax-free savings accounts are a great tool to use. And it's nice to see that the cumulative limit is now getting up into numbers that really will help Canadians make a difference with their retirement savings and their tax burden that otherwise would go along with it.
Yeah, if only it were easier to figure out where your TFSA room is. I find that's where people have difficulty. If they've not maxed out every January, looking it up with CRA, there's always a bit of a lag in what your TFSA room is. Just make sure you confirm your limit with CRA. Know that it's always as of the previous year, especially the next 6 months. You're probably getting your TFSA room as of January 1st, 2024. And you've got to manually calculate TFSA contributions you made in 2024 to make sure you don't go over on your limit.
Yeah, what we're seeing in practice, TFSA limits are not necessarily up to date on CRA's website until perhaps even the second half of the year. So you just need to be careful if you are looking online that you do have fully current information at hand.
Yeah, I have noticed that mine was definitely inaccurate when I looked it up. I calculated myself, but I remember I was surprised because I think a lot of Canadians, maybe they get a bit thrown off by it as well because, correct me if I'm wrong, but when we get our tax returns back and we see our RRSP contribution room there, I've always found that number to be, okay, this is what I have. This is my new, my room. And I kind of take that as gospel, so to speak. But with TFSA, it's like, oh no, wait, I have to actually, that might not be accurate. And they even have, I noticed, a little disclaimer on their site saying, hey, just so you know, this number we're giving you might not be accurate. Do you find RSP is usually pretty accurate as opposed to the TFSA?
Yeah, I think so. RSP room tends to be pretty accurate. Where it may be a little bit off when you get your notice of assessment is if you're making regular contributions, either running a monthly or maybe a bi-weekly contribution from your bank account, or if you have employer RSP contributions going on. Your notice of assessment would be accurate to the end of February, typically, the first 60 days of the year, but contributions made after that point may not be reflected.
Okay. That's a good point. Yeah, because I guess it needs time to refresh and all that. And
That's right.
That makes sense. So if you're doing it so frequently, then I could see that happening. Okay. Sounds good. What else, guys? What else should we be aware of as the new year kicks off here?
Well, maybe we stick with RSPs. Our RSP room that you mentioned there was is up to $32,490 for anyone who's entitled to the maximum RSP contribution for 2025, which I've got to do the math. 32.
You need $180,500 of earned income.
This guy knows it right off the top.
I did the math.
The other kind of neat thing, the other neat thing about RSPs, or I guess one of the changes for 2024, is the 2024 federal budget bumped up the home buyers plan withdrawal from $35,000 up to $60,000. So you can now pull up to $60,000 out of your RSP for the purchase of an eligible first home. And interestingly, if you combine that with the FHSA, the first home savings account that was introduced originally, the FHSA wasn't going to be allowed to use with the home buyers plan, but you can actually pool the two programs together to take a pretty significant withdrawal from your tax preferred accounts.
And for FHSAs, you can contribute $8,000 in the first year, up to a lifetime limit of $40,000. So I guess it's the government's way of allowing some tax preferred savings to be used as housing prices continue to increase. It's nice to be able to dip into both buckets.
That's good. And then RESP, we haven't touched on that one yet. Any changes in that regard?
Nothing new, really. $2,500 annual contribution that attracts the 20% Canada Education Savings Grant. But you can catch up on one previous year. So if you've missed years of contributions, you can do $5,000 of contributions for a beneficiary and get the 20% government grant. But I mean, technically you can put in more to your RESP in a given year. You just can't get a government grant. There's a $50,000 lifetime limit for the beneficiary. But that 20% government grant is pretty lucrative and, worthwhile to try to take advantage of.
For sure. Yeah, that sounds good. Yeah, I just do the usual $2,500 per kid, put in, $500 shows up for each kid after a while, invest it, and then we're basically done for the year and you just keep letting it compound. So yeah, that's good. Any changes in terms of the lowest federal tax bracket? Obviously we've got like early retirees, traditional retirees that like to play with that, right? To try to always stay in the lowest tax bracket. Can you talk about that as well as the basic personal amount, which I know, again, the retirees and those kind of in that boat like to play with that as well?
Sure, yeah. The lowest federal tax bracket now sits a little over $57,000, so $57,375. There are provincial brackets as well that may or may not line up exactly where federal brackets reside. But that gives us a lowest marginal tax rate ranging from 20 to 30%, depending on where you live. Each province will be a little bit different. With marginal tax brackets, we're always looking for opportunities to plan. So one of the things when we look at the lowest bracket is we don't want someone to have income much lower than that in one year and much higher than that in a future year. If we're able to spread clients' incomes more evenly to take advantage of low brackets where they exist, then ultimately we think we're doing a good job for our clients. It's better to pay tax and use those low brackets up rather than have a year where you pay next to nothing and then a year where your income falls much, much higher. So if we can find a way to spread things out evenly, then we are doing well for our clients.
Mm-hmm. Yeah, the whole income smoothing strategy, essentially, which I find, once you're retired, that's a lot easier to do, as well as if you're incorporated as well, right? Because you can actually decide how much salary to withdraw, how much dividends, that kind of a thing. So you get a lot more sort of things in your toolbox that you can do to make sure you're always in the lowest bracket. Okay, that's awesome. Did we talk about basic personal amount yet? I don't think, right?
The federal basic personal amount is around $16,000. So that's the amount of income that you can earn before you pay any federal income tax. But there's a provincial basic personal amount that ranges from about $9,000 in Nova Scotia to over $22,000 in Alberta. That changes the exact amount you can earn tax-free in your province. But I think same as the lowest marginal tax bracket, as Paul alluded to, you probably want to at least try to take advantage of those basic personal amounts. And we were just talking about RESPs. It kind of ties into RESP withdrawals. You've got a portion of the RESP withdrawal that you take that's taxable to the beneficiary. And you probably want to take advantage of, employment income plus the taxable portion of the RESP withdrawal, ideally at least using their basic personal amount, but something to be mindful of for sure.
And one little nuance that has arisen with the basic personal amount in the last few years is that for those at the high end of the income spectrum, the personal amount is clawed back just a little bit and could fall to $14,000 and change for high income earners. So the $16,000 limit for 2025, that that applies to most, but not necessarily all.
Okay. So if you're in a high tax bracket, all the more reason to max out your RRSP, FHSA if you qualify, just because if it can help you not get to that threshold where you're now getting a reduced basic personal amount.
Absolutely. Yeah. With tax planning, often we're looking at ways to reduce the income that's being reported in order to limit what income is taxed at those highest possible rates. So anything we can do that will allow someone to report lower taxable income tends to be a good thing.
And now a quick message from one of our sponsors. Many of us don't know that our personal private data is packaged and sold on the open market, resulting in us getting things like spam phone calls, junk email, and increasing our chances of identity theft, not to mention compromising our personal security by others knowing exactly where we live. There is an entire industry of data brokers that buy and sell our personal information. Oftentimes, this is used for spamming us with marketing calls and email. And we actually had this happen to us where when my daughter was born, we ended up on these lists and were repeatedly called by some of these less than reputable investing companies who knew that my daughter was just born. And so they started pitching us to set up an RESP for my daughter's education. And of course, they left out that part about charging exorbitant investment fees for their service. How's that for a breach of privacy? You're probably already on a lot of these lists too, and there are over 100 data brokers out there, so it's extremely tedious and time-consuming to reach out to each one yourself and ask to be removed from their lists. That's where Incogni comes in. It's a service where you give it permission to go out and remove you from these lists. They send out requests to these data brokers to remove you, and you can see how many lists you're on and monitor how many they've removed you from already. I encourage you to check them out, and you can try them out and receive a discount by going to incogni.com/buildwealth. That's Incogni, INCOGNI.com/buildwealth. All one word, incogni.com/buildwealth. And that link is also in the description for this episode.
Are you buying Canadian? Well, why not invest Canadian? At BMO ETFs, we're committed to helping you build a brighter financial future because it's our future too. This is our home, and as Canadians ourselves, we know what you need to grow wealth right here in Canada. Visit BMOETFs.com for more.
The other thing we had on our list here was the Bear Trusts. There's been something in that area. Can you guys explain me as well what that is for anybody not familiar, as well as the changes?
Sure. Yeah. Bear trusts are the kind of trust that isn't documented specifically. It tends not to have anything in writing. But bear trusts exist where one person has legal title and they are holding that legal title for the benefit of another person. Examples of this could be a parent adds a child's name on their investment account for ease and estate planning reasons, but doesn't actually intend the gift. That child would be holding the legal title to half of that account, but holding it effectively in trust for the parent. There are new rules for trusts that arose a few years ago that said Bear Trusts would need to start filing tax returns to report certain information, even if there wasn't significant financial activity to be reported in the trust. Information about the settlor, the trustees, and beneficiaries would all need to be reported on a new Schedule 15. The rules that got put in place, I think they were designed really to catch more sophisticated, complex scenarios where people might have been disguising what was really going on, but the government cast a net that caught a lot more than just that. And one of the good things, I guess, that's fallen out in the last couple of years is the government has said for 2023 and 2024 years, Bear Trust would not be required to file. Even though the rules have changed, they've made an exemption for those years. Going forward, we don't know exactly what the future will look like. There are a number of proposals for tax years starting in 2025. That say certain Bear Trusts would be exempt from filing. So those that have less than $50,000 of assets during the year would be exempt from filing. Also, if all the parties to a Bear Trust are related, then that $50,000 limit increases to $250,000 as long as there are certain kinds of assets in there, like cash, GICs, stocks, bonds, mutual funds, and ETFs. So sort of standard investment type vehicles. There are a few additional proposals that suggest that spouses who share a joint bank account for the use and benefit of both would be exempt from filing. Parents who've been added on legal title to a principal residence of a child may be exempt as well. But these are all still proposals right now. So this is an area that has some uncertainty, and we will need to pay close attention going forward to exactly what the reporting requirements will be. But good news for this tax season is that trusts, including Bear Trusts, for 2024 are exempt from having to file a tax return unless they meet other conditions outside of Schedule 15. For those who don't file when they should, there's a penalty for filing of $25 a day to a minimum of further clarity on what trusts need to file and what trusts don't. It will be important to make sure people stay compliant to avoid the possibility of these significant penalties.
Mm-hmm. Mm-hmm. When you guys work with your clients and things like this happen where, okay, there's a proposal, but it hasn't actually been solidified yet, what tends to happen? Like, do you just email all your clients, or how do you typically work with these kinds of things when these noticeable changes happen?
It's been messy the last couple of years with these Bear Trust half announcements and then changes the last minute. And they did the same thing with underused housing and now capital gains, which we'll get to. But it's been a gray area for some of these tax proposals. But generally, we're trying to bring it up in conversation. We may send out, an email blast if there's something specific. But I think there's been a lot of uncertainty, and there still remains some uncertainty with exactly how 2025 will look for Bear Trusts, for example.
Yeah. And then, that brings us to the capital gains inclusion rate, which we can talk about in a second as well, because that's another thing that's proposed and then not official yet. And that's a whole can of worms. But maybe before we talk about that, the other major potential change for this year, for anybody new to this world of Canadian financial planning and optimization, Jason, can you take us through what an advice-only financial planner is? So basically what you are at your firm compared to a more traditional financial advisor title role here in Canada.
Mm-hmm. And interestingly, I feel like there has been a little bit of a shift or a change in the last year in that regard. I mean, fee-only financial planning has been around for a long time, since the 1960s in Canada, but it's, just starting to gain a little bit more momentum, I find. I originally called myself a fee-only financial planner. I've switched to often using the term advice only to sort of clarify, because there's a lot of, fee-based asset managers, portfolio managers who charge a 1.5% fee on your investments. And now everyone is sort of fee only, so to speak. Advice only sort of clarifies that we sell advice. We sell our time, like an accountant, like a lawyer. And we provide financial planning for an hourly fee or project fee or an annual fee without selling investments, selling insurance. And it's interesting because I feel like there's been a slow build to the media, mentioning advice only and reaching out to others in the advice only community. And it really sort of hit a fever pitch, in my opinion, that there's a lot more people talking about it. It's still a relatively small market here in Canada. I'd say under 200 people who provide services this way. It's a lot bigger in the US, but we tend to be a little behind what they're doing, although we're catching up.
Yeah, it's one of the big reasons I like having you guys on is because you don't actually sell investments. And so typically if I'm interviewing someone and I know they actually sell something, then it's like this whole thing where I have to research it and find out, okay, are they just going to be giving me a one-sided answer because they sell that product or their firm sells that product? And so there's this like conflict of interest, right? And so I generally try to stay away from interviewing those kinds of people because, we're trying to get an unbiased pros and cons version of the different options available, as opposed to with some of these products out there, if you ask someone that sells it was that expression, right? Where if you have a hammer, everything you see is a nail, right? And it's like, all right,
Yep.
this is going to work for this, it's going to work for that, it's going to work for that. And then you kind of think, okay, they're being a little too rosy on all the positives, haven't mentioned any negatives. That's usually a pretty big flag because especially in this financial planning investing world, it's so much of it is about trade-offs, right? There's not this one thing that's perfect with no limitations. So anyways, it's always, I really appreciate you and your team coming on the show many times now to give us your expertise.
Look, we appreciate it too. And I will say that there's a lot of great, trustworthy, honest people in the business of managing investments and selling insurance. And there's a need for those things too. So it's not to say that, it's a good versus bad. It's more that there's, an importance to understanding how the person giving you advice is getting paid. And, we're providing financial planning for a fee, a lot of times with a retirement and tax focus. And the community is definitely growing. So thanks for having us on again.
Awesome. Yeah. And just real quick before we dive into the next tax question, just for anybody curious, what kind of clients or types of Canadians do you typically work with? Is there a particular group that you favor or specialize in, anything like that?
I wish I could say there's a profile because it would make it a lot easier elevator pitch. But no, I mean, we've got clients. I had a conversation this morning with one of my clients' children who's in their late 20s. We have clients who I was emailing with a client in their 80s. I would say that we have a disproportionate number of clients who are business owners. I think that's probably because those individuals they're used to paying for advice. They're used to paying accountants and lawyers. I think have a different appreciation. Maybe so disproportionate number of business owner clients. They also don't have pensions and they've got a lot more decisions to make. But generally speaking, it's all kinds of different people, different ages, stages, levels of wealth, income. And unlike a portfolio manager who might have a minimum investment, somebody doesn't need to have a certain net worth or level of income to work with us. Although, we do tend to find we work with clients with a little bit more complexity. But happy to chat with anybody who might be interested in what we do to see if we can be of assistance.
Awesome. Yeah, I know in the past you've offered a free introductory consultation for anybody interested, as well as a discount to Build Wealth Canada listeners that do actually end up working with you in like actual professional context. Can you speak to that as well, just for anybody interested?
For sure, and I think we'll do that coming into this podcast again as well through your website with a 10% discount on financial planning consultations that we provide to any Build Wealth listeners as a show of gratitude. And the other thing that I should mention is that we work with clients that are all over Canada. We've got employees all over Canada. We've got somebody in Squamish, British Columbia. We've got somebody in New Maryland, New Brunswick, and sort of everywhere in between. Although we do also work with clients, interestingly, who are outside of Canada, typically individuals who have Canadian ties and might just be living or working somewhere else in the world. Actually, my call this morning was somebody they're in Bali, Indonesia, as it so happens, and they're temporarily, but returning to Canada at some point in the future.
Mm-hmm. Awesome. Okay, that's great. Yeah. So, thanks for the discount, offering that to the listeners of the show. The page that we built for you last time you were here, it's still up. It's working for anybody that wants to reach out for the free consult. And then if you go to that page, you'll get the discount as well. If you do decide to work with Jason and his team, if you find that it's a good fit. So for anybody interested, that page is buildwealthcanada.ca/Jason. So just buildwealthcanada.ca/Jason. And then there you can put in your info. It's going to go directly to Jason and his team, and then they can send you information, and then you guys can both see if you're a good fit for each other and if it's something you want to do together. And if you do, then you get the discount. So thanks again, Jason, for offering that. That's wonderful.
Sure,
Awesome. Let's talk about the elephant in the room, the changes to the capital gains inclusion rate, which we've already alluded to earlier. This could have a major impact for many of us here in Canada, but I think there are also a lot of misconceptions of who this applies to and in what situation. And then with Trudeau resigning, like that kind of threw a wrench into things even more. Can you take us through what this is for anybody new to it, And what are you advising your clients to do who are impacted by this or who may be impacted by this?
Sure, yeah. So for the last 25 years or so, the capital gains inclusion rate has been 50%. And what that means is that when we calculate a capital gain, we take what we receive when we sell and we subtract what we paid when we bought. And that difference is a capital gain. And we take half of that and include it in our income. Then taxes calculate on that amount. So 50% isn't the tax rate itself. It's just the portion of the gain ends up being subject to tax. And the current government has made a proposal from the April 2024 budget that was to come into effect on June 25th of 2024, that in most cases, the capital gain inclusion rate would rise from 50% to 66 2/3, meaning that a greater portion of capital gains would be included in income and subject to tax. There was an exemption for individuals for capital gains realized in the year up to $250,000. That applied to employee stock option benefits as well. But for individuals who have gains in excess of $250,000 in a year, as well as for all corporations and all trusts, the inclusion rate was scheduled to increase as of June 25th. As of, I think, September this past year, the proposal got as far as the second reading in the House of Commons, but there's been no vote, and the legislation did not receive royal assent, meaning that this is not yet law. In November, CRA said, well, we're going to still assess taxpayers based on this rule having changed, even though it hasn't actually occurred yet. And that is a little bit uncommon to see that happen when a law isn't passed, especially with the potential turmoil that is going on at the federal government level right now. Government has been prorogued, meaning that any legislation that was in the works and not yet passed has all effectively been canceled. So the proposals are effectively dead, but we don't know if they will be renewed when the government continues later in March. And if not, what will the effect be of an election down the road as well? So there's a whole lot that is up in the air right now. And current state of affairs is that CRA is instructing taxpayers to proceed as if it is law, but that's not actually the case. So in the professional community, we're having lots of discussions amongst myself and other tax folks to say, well, what do we do about this? This is fairly unprecedented that CRA is asking taxpayers to pay more than what the law calls for. I think for the most part, it seems like collective wisdom is suggesting that all we can really do is inform clients of where things stand, suggest that if we take the position of filing as though the law has passed and potentially pay more tax than is required, then we can adjust after the fact and request a refund. Or we can take the position that the law hasn't passed and therefore we're filing based on the pre-existing rules, knowing that if it ultimately does come into effect, it could come into effect retroactively back to June 25th of last year, and that could cause more tax to be paid. So really at this point, it ultimately would be up to clients to make a decision, hopefully with good information provided by the professionals to say, yeah, I'm more comfortable proceeding, option A or option B. Given the massive amount of uncertainty about all of this, I'm personally inclined to file based on the 50% inclusion rate continuing to exist. But that is a dynamic environment, to say the least. So that's sort of where things stand right now. There are some legal challenges that have commenced. There's some applications for judicial review that are underway that I got some copies of yesterday, actually, challenging the fact that CRA is administering this change, having become law first. And hopefully these issues will be heard quickly and decisions can be made. So at least we have some level of certainty for this upcoming tax season. But right now, this is a real dog's breakfast in terms of our tax reporting to say, what should we do? We don't really know where everything stands. So we have to take one position or another and then just stay on top of things going forward.
Mm-hmm. If we make the assumption, like you mentioned, there's kind of two options, right? You either say, okay, let's assume it's already changed, or assume that we're going to keep it at 50%. Let's say you went with that option of, okay, it's not law yet. I'm out for myself. I want to keep it at 50% when I file my taxes. If, let's say, it does come to pass and they do the whole retroactive thing, then, okay, I'm going to owe more tax because of that. But do you know if they would also at that point charge me interest? Because they'll say, oh, well, you actually underpaid tax and we told you to assume it was going to become law, but you said no, I don't believe you or whatever. So are they going to, of course, I get the whole retroactive tax thing, but then am I also going to get penalized as like a late payment, essentially, where they start charging you interest for it? Because I should have technically paid because that's what they said. Do you have any thoughts on that, or what would happen?
I think interest would not be charged up to the point where the law is passed. So government is scheduled to resume. I think it's later in March when Parliament will resume. So I don't think there would be any interest between now and then. And then it would be a question of how long after your payment date are you paying if this does become law and you should have paid more and you're past that filing deadline or the payment deadline. So I think there will be a gap of time where interest won't be charged given the fact that this is uncertain.
And now a quick message from one of our sponsors. If you were to pass away, does your family have enough to pay off your mortgage and other debts? Will they have enough to keep the same standard of living with all your income gone? And will your kids still have enough for post-secondary education? Term life insurance is the most recommended type of life insurance by Canadian financial experts on the show and has been for the past 10 years. A big reason for this is that it is typically the least expensive option when it comes to life insurance, and it is flexible where you are not locked into a long-term contract. Our show sponsor, PolicyMe, is proudly Canadian, has a 4.8 out of 5 star rating on reviews.io, an A+ rating from the Canadian Business Bureau, a 4.9 out of 5 rating on Google Reviews, and when you insure with them, you get $10,000 in free life insurance for each of your kids and any future kids you have. Plus, you get no fees or penalties if you ever decide to cancel, and any payouts you get are also tax-free. I encourage you to get a no-obligation quote and learn more by going to buildwealthcanada.ca/policyme, all one word. That's buildwealthcanada.ca/policyme.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
Okay. So you're saying maybe something like some sort of grace period, like, okay, now it's the law, so you should have paid more. We're going to give you however much, like a month or whatever they decide is reasonable. And then you need to pay us that extra amount now. And if you don't pass this date, we'll start charging you interest. Like that's kind of what.
Well, yeah, I think there would be a grace period up until the point of the law passing.
Mm-hmm.
After that date, until you pay it, I would have question marks whether there could be additional grace provided, or if they would start charging interest like the day after the law receives royal assent. That I'm unsure of. It wouldn't shock me if there's a bit of a grace period, but I'm more confident to say up until the point of time that the law passes. Then that I'm confident you would not owe interest until it actually becomes law.
Okay. Do you have any recommendations in terms of how we as Canadians can keep on top of this to find out if or when it becomes law? And what's that date again where it might become law? Do you know that?
I think the government is scheduled to resume. I don't remember the exact date, but I think it's March 23rd, give or take, somewhere around that time
That's
frame.
right. Yeah.
Then the legislative process would have to commence again, where they'd have to reintroduce the bill and then but go through the various readings to ultimately receive royal assent. How quickly that could happen really depends on the willingness of the government. So I'd say shortly after, say, the end of March, this law could come into effect if the government is inclined to try and push it through.
Okay.
It doesn't sound like there may be as much willingness as there was in the fall, though. So that's a very big if.
Okay.
I'd say maybe the earliest it possibly could come into effect might be mid-April. That's a bit of a guess on my part, but I think staying in touch with this issue will be important. Certainly in the tax community, there is lots being published on this regularly, and perhaps that's one of the advantages of working with a tax professional or a financial planner is to have someone else who is monitoring this on your behalf. So we'll certainly be doing that on behalf of clients and keeping them informed. But for those who want to look after this themselves, I'd say a Google search on capital gains inclusion rate news every so often might be warranted this spring.
That makes a lot of sense. Yeah. Whereas if someone already has an account, like working with you guys, for example, then it's okay. Here's it's law. Here's the implications. And then you can actually plug it into your tax software and say, here's how it actually impacts you specifically. Therefore, we should do X, Y, Z. Here's when we should pay it. And then it's a bit versus like trying to piece all the pieces together yourself from like a Globe and Mail or Financial Post article. That kind of. So you got like the DIY option, or you already work with an accountant. It's gonna be stressful for the tax software providers, like the TurboTaxes of the world, right? Because they update this software every year based on the latest taxes. They're already selling this to Canadians, and then they've got this big question mark.
Absolutely.
And it's like, all right, I guess we're rolling out this update and then people are going to call and complain like, I didn't know, and it's going to be a whole.
They can't charge extra either. It's just a cost for them.
Yeah, it's a lot of work on the software side, and I'm hearing from them as well. I get regular email blasts, and CRA has promised to have updated forms for January 31st. But with the challenges to CRA's position that they're going to start administering, they may have to reverse all of those changes and get back to how things have been in previous years. So, lots to keep our eye on in this department, to say the least.
Yeah. And in terms of practical implications, the two types of Canadians that I see, and please add any more if you think I missed one, but the two that kind of really jump to my mind when I think of this, of who would it really impact, would be one, individuals who have a property other than just their primary residence. Just because for anybody new to all this, your primary residence, it's tax exempt from capital gains. However, if you have something like a cottage or a rental property, that is treated differently. You are not capital gains exempt in those situations. And so you talked about, I believe, Paul, you mentioned like the $250K limit, if I remember correctly. Well, if you're selling like a rental property or a cottage, especially with the craziness of real estate prices in Canada and how much they've gone up, I'd be willing to bet there's a very good chance you're getting more than, you're going to reach that threshold potentially. And so obviously this could have huge implications for you, because all of a sudden you might jump to the highest tax bracket because of this capital gains inclusion rate. So I did want to kind of stress that to listeners of the show, where this isn't some like, save $20 on groceries thing we're talking about here. This is, okay, if you've got like a rental property, I mean, this could be in the thousands of dollars of implications of extra taxes you might pay, especially if you're already at a high tax bracket. So there's that piece. And then the other person I think this really applies to would be people that have their own corporations, like, the doctors of the world, or people just with their own small businesses, that kind of a thing, who invest, like, for example, myself, as Build Wealth Canada, if I have some extra money in there, I'll invest it in ETFs within the corporate investing account. But like you said, Paul, Canadian businesses are part of that. So if I'm investing in ETFs, now instead of getting 50% capital gains inclusion rate, which I would get if I invested in my personal account, instead I'm going to be getting 2/3 inclusion rate, right? So now it gets into this thing of, well, how much should I be investing in my corp? Should I still keep investing in my corp? Should I sell now before these things come into play? Because now I'm still like if someone sells right now, are they still just going to get 50% because it's not law yet? Can you comment on that?
Well, yeah, the proposal says June 25th of 2024. Okay. So there was a fair bit of activity that occurred prior to that date where people were realizing capital gains to try to avoid that higher inclusion rate where they could. When this law, if it were to be reintroduced, we don't know if it would be retroactive to June 25th last year, or if they might set a new date for it. So I wouldn't count on being able to sell today and guaranteeing 50% inclusion rate. I think that ship effectively sailed for June 24th last year. So I think at this point, for those who are considering selling, maybe there are bigger reasons than tax where you just have to make decisions anyways, to understanding the uncertainty here. One thing to mention too, the effect of this increased inclusion rate is that capital gains you'll pay probably in the range of 7 to 9% more than what you would have before. That's sort of the impact of the increased inclusion rate. So before, if you might have paid about 25% tax on capital gains when you're a high income earner, well, that now might look more like 33 to 34% in Ontario, for example. So for those selling secondary vacation properties, cottages, things like that, gains are significant. We're seeing clients with very significant capital gains falling well over that $250,000 threshold. Yeah. And what we can do about it today, we are really limited because we just don't know what this law is going to turn into. One of the solutions that may apply if you do sell real estate and you have the option to delay receiving the proceeds, we can use a tool called the Capital Gains Reserve. And that reserve allows us to spread the gain over multiple tax years if we receive the proceeds of the sale over multiple tax years. If you receive 20% of the proceeds per year for 5 years, then you can have the gain show up on your tax return 20% a year for 5 years. That's as far as we can possibly spread it. So if you're selling real estate and you have the option to delay receipt of proceeds, that could be an avenue to explore as a possibility. There is a downside to not collecting all the money up front, though. You don't have to put it to work, and there is some risk in the buyer coming through with those payments. But that is a tool that we have to work with from a tax planning perspective.
Yeah. That's a very good point. Yeah. So it's a way you can do kind of more like the income smoothing you were talking about earlier, where you're trying to stay in the lower bracket by not having all the money come at once. But then, yeah, like you said, there's the opportunity cost. Well, if you got that money all at once and we, let's say, put it into ETFs or something like that, okay, so what's the opportunity cost for doing that? Yeah, that's a tough one. That's why I'm glad you guys exist to help people with these decisions. Because I mean, you're dealing with hundreds of thousands of dollars. I mean, even millions, right, with some of these properties. So sure. This is not like, again, this is not like a 20-cent coupon that we found on our grocery bill. It's things that can actually move the needle in terms of our
I think we'll all feel a little bit better when we get some certainty around this one way or another. Hopefully the inclusion rate stays at 50%. Obviously, we're in favor of lower taxes than higher taxes. But at least having solid ground to know what we're working with will give us the ability to continue our planning work with clients.
Sounds good. All right, that sounds good. Oh, sorry, Jason, were you going to add something or are you good?
No, look, I think all great points and good way to wrap up that discussion. And, eventually we'll have some certainty.
Sounds good. Yeah, well, let's move on to the next question. But I think, once this becomes solidified or once we know for sure what happens, that should be another episode that we do. Because like we said, there are implications, right? Like, do I keep investing in my corporation when it's no longer 50% inclusion rate? I mean, that's a mathematical thing that you can try to figure out using this different software to see kind of what is the more optimum for you. So, but that's like a whole nother optimization rabbit hole we can go on. Paul, while I have you, one little thing that I wonder about is the importance of tax planning. I get the impression that most accountants are tax preparers, not tax planners. Can you talk about this?
Yeah, I agree with that statement to a large extent. I think a lot of times accountants are called upon to report on what's already happened. And I refer to that as looking in the rearview mirror. So clients have financial activity that occurs during the year. And then the accountant says, well, after the end of the year, send me your stuff and I'll prepare your return, whether it's personal, trust, or corporation. They're looking backwards, not looking forwards. I'd like to spend most of my time helping clients look forward down that road because we have a much greater ability to impact what the future tax picture looks like when we have time to plan for it. So in some cases, I think accountants are really just engaged to prepare financial statements and tax returns, and clients may not be asking them to do any more than that. Maybe accountants should be pushing that agenda more than they do, but it might be questions of simply engaging or not. But there are also many accountants who have, I'll say, fairly limited expertise in the tax department. Maybe tax reporting, they're pretty comfortable, but tax planning is really its own discipline. And not everyone has the same amount of expertise or experience working in that department. So I think it's always good for clients to find someone that they can engage to help them look forward and figure out how to change their tax reporting in the future by looking to optimize their affairs, looking at all the possible things that can be done to figure out what suits in their individual circumstances. So I certainly would encourage any of the listeners to find someone who can assist on the tax planning side to say, well, based on what has gone on before and what my goals and objectives are, what might I be doing differently going forward that could make me better off, make my family better off, maybe give me more dollars to donate, leave to others, whatever the case may be. So certainly I'm a big proponent of proactive tax planning, and that requires looking down the road well ahead of time, not just in that rear view mirror.
Mm-hmm. Yeah, especially like when you mentioned earlier about income smoothing, right? And trying to not have all that income come at once, because of, let's say, sale of a vacation property or something else or some other investment, to be able to strategically plan out income in such a way where over the long term, you're in the lowest tax bracket possible, things of that nature. So I can obviously that requires so much planning as opposed to just retroactively looking at it and say, oh, I guess we're paying a lot of tax this year. Okay. And then you're just bitter about it when maybe there was something you could have done with enough planning.
Yeah. When we find out in April that someone has a large tax bill, it's too late to go back to the prior year and make changes, right? So the more notice that we have, the longer a runway we have, the better we can do for clients in figuring out what makes sense to consider for them.
Mm-hmm. Yeah, and I mean, so far, like in the situation we were just talking about, I imagine that applies a lot, especially to clients who already have a fair bit of income or a fair bit of net worth, because there's more, maybe they have a business here, rental property here. So obviously that's highly relevant for those people. But for the listeners listening who maybe aren't at that level yet from a net worth side, I will say that this kind of tax planning is very relevant for you as well, because especially when it comes to things like government benefits, right? Like, so I know in my case, I've been optimizing a lot about maximizing the Canada Child Benefit that we get, the CCB, as we have 2 kids. And then for retirees as well, there's OAS, there's clawbacks as well if your income is too high. There's GIS, which you may be eligible for with the right tax planning potentially as well. So there's all these kind of levers that you can pull now as well. There's the dental plan as well coming into play, or that has come into play from the Canada. So there's all these different government benefits as well that you may become eligible for with the right tax planning, because, let's say you put money into your RSP and now it puts you in a lower bracket and now you get less clawbacks of this, or you're now eligible for the dental plan, all these different things. So I really do want to encourage people to not just kind of think, oh, well, I don't have a, $500,000 portfolio, so this doesn't apply to me. It's like, well, that's not the case. There's so many other levers out there in addition to how big your portfolio is and how big your assets are. So yeah, I just wanted to kind of go off on a minor tangent on that because I didn't want people to think this doesn't apply to them when tax planning does. In fact, especially if maybe money's tight right now, I mean, well, these benefits can really help. Oftentimes they are there to help people who are in the lower income side of things. So it is something to think about and have on your radar, and not just think like, oh, this is only for the doctors in the crowd or the wealthy business owners in the crowd. Okay, anyways, I'll get off my pedestal, but I just thought I'd mention that because these things can really, Canada has some really good benefits for individuals, especially those that need it. So worth mentioning for sure. One very attractive headline that I see here in Canada from time to time is that for 2025, for example, Canadians can receive up to, it's a bit over $53,000 in eligible Canadian dividends tax-free if the investments are in their taxable investment accounts and if they have no other sources of income. Now, some retired couples and aspiring early retirees will then reason that combined with their spouse, they can each earn that $53,000 plus tax-free every year. So basically almost $107,000 together. Then they can just live off their dividends in retirement, pay no income tax, never have to sell anything again, not worry as much about the market downturns because they don't have to worry about selling at the bottom, things of that nature. Now, this strategy may sound very attractive at first glance. And I remember like years ago, like over a decade ago, reading that article in Money Sense for the first time, and it blew my mind. Like, what? You can get like $50,000 or whatever it was at the time, tax-free in dividends. This is amazing, right? But there's a lot of different caveats and very easy mistakes to fall into when it comes to this strategy as well. So I wanted to make Canadians aware of that because they're going to see some of these headlines, and I think this is something that we need to be educated on. Can you guys unpack this for us so that we are all aware of this strategy, but also so that we understand its risks and limitations?
I'm happy to speak to some of the non-tax implications because I think there's tax and non-tax here. But Paul, do you file a lot of tax returns like that where somebody's got $50,000 of eligible income and no other income? Is that a real thing?
I think this is a theoretical possibility. It may not be a practical possibility.
I think it's uncommon. You don't see it happen a lot. It would require somebody to retire at a relatively young age with a ton of Canadian stocks, and the ton of Canadian stocks in their non-registered account part, I think, is one that sort of sticks out to me. If you look at high dividend yielding Canadian stocks that would pay these so-called eligible dividends that you could earn a bunch of tax-free, they tend to be from a pretty narrow sector of the stock market. It tends to be, utility companies and telecoms and, oil companies or banks. You end up with a portfolio that's not very well diversified. So I think your drawback from a financial planning perspective is that, you may be putting too many eggs in one basket just to save a little bit of tax. And, I think 2024 is a great example. I mentioned telecom stocks, and I don't know what Bell Canada finished the year at, but I think Bell was down like 25 or 30%. And then you had high flying tech stocks not paying any dividends and, paying US dividends that did extraordinarily well. So I think you've got to be careful about letting the tax tail wag the dog, so to speak, and ending up in a position where you've got a really unbalanced portfolio.
I think from a tax perspective, I certainly agree with what Jason just said about the importance of building a portfolio that's suitable based on considerations, maybe including tax, but not solely about tax first, and then worrying about the tax consequences second. Eligible dividends are taxed at low rates, particularly for those in low income brackets. But ultimately, for those who are earning higher amounts of income, the capital gains are actually taxed at lower rates than eligible dividends. Mm-hmm. So I think it's important to understand how eligible dividends may fit into your picture, but building a portfolio that drives returns exclusively as eligible dividends, it's pretty tough to do. It probably doesn't make any sense from an investment standpoint, which really I think is a bigger issue than just the tax side. So one of the things we liked about capital gains as well is that there is some discretion as when you realize them. you can decide when to buy, when to sell securities to some extent. So we have some ability to manipulate our income levels year by year by triggering capital gains or losses or not. Eligible dividends are paid out every year. And I think the other big issue with that is for those in retirement, it's very unusual to have no income other than your dividend yield from your portfolio. Even just CPP and OAS coming in gives you some level of income, and the tax efficiency of eligible dividends begins to decline as you have other income to report. So in theory, it might make a lot of sense, but practically speaking, I think this is a pretty tough goal to achieve. So eligible dividends are valuable from a tax planning standpoint. They're taxed at lower rates than interest or foreign income, but maybe too narrow a field to really rely on entirely.
Wonderful. While on the subject of dividends, one big consideration for Canadians is that when we receive Canadian dividends in our taxable accounts, those dividends can increase the speed at which we start getting clawed back on our government benefits, like the Canada Child Benefits or the CCB and the Old Age Security OAS, for example, because of the gross up that occurs. One potential solution for this is to use corporate class ETFs. One that comes to mind is HXCN from Global X. They were known as Horizons earlier, and then they did the whole rebranding thing. So now it's called Global X. What are your thoughts on these ETFs? And can you give us your thoughts on the extra risk that we are taking on by using this type of structure where our dividends are essentially being turned into capital gains so that we don't have to worry about these clawbacks as much?
Mm-hmm. Yeah, if I can just speak first to the gross up of dividends to explain how that works, and then maybe I'll hand it back to Jason to talk more on the investment aspect of that question. Eligible dividends are grossed up by 38%, meaning if you have $100 of eligible dividends, you actually are reporting $138 of taxable income. So at first blush, your tax bill increases because of this gross up. But then there is something called a dividend tax credit. And for eligible dividends, that credit is pretty significant. And that credit has the effect of reducing your tax bill. So at first, we're calculating tax on $138 of income, but then we get a tax credit that reduces that tax bill. And for those in low tax brackets, the tax credit is very significant relative to the tax rates. But with that gross up, as was mentioned, it has an impact of increasing your taxable income. So for any benefits that are income tested, like OAS for those in retirement, then this becomes an issue. The other thing that this does is it pushes taxable income higher. And if you have any other types of income, if you're withdrawing from your RSPs or your RIF in retirement, or you've got salary still from your employment going on, your taxable income is just pushed to a higher level if you have significant eligible dividends than it would be otherwise. Whereas capital gains, less than 100% of that gain is included in income, hopefully 50%, as we've been discussing, possibly 2/3. But the impact of including capital gains is far less than including eligible dividends, and it can have sort of a cascading effect.
So, Jason, you were going to speak to your thoughts on
the investment side and some
that kind of
rewards, for sure.
Versus going with like a general,
just a regular
Canadian S&P TSX ETF, for example.
Yeah. So you mentioned the Global X group of ETFs. Used to be Horizons, now Global X, and they've got a number of ETFs that turn current year income, like interest and dividends, into deferred capital gains using a corporate class structure. As far as I know, those are the only Canadian ETF providers that do that. There's a number of mutual funds, there have been for some time. So there's other products, I suppose, that can turn income into deferred capital gains. And it could be advantageous from the perspective of somebody who's got a taxable account, whether it's a non-registered account, a corporation, a trust that wants to have tax deferral. It can be advantageous. I mean, you alluded, Cornell, to government benefits, and having less income and therefore more benefits. There are drawbacks. There's been some, changes to tax legislation around the way that, the old Horizon swap-based ETFs were structured. So they converted to a corporate class. There's also this, particularly with Global X, counterparty risk. They still use swap contracts that they enter into. And maybe just step back a minute. When you buy an exchange traded fund, you can buy a physical ETF where the ETF literally buys the 500 stocks in the S&P 500 and it literally owns all the shares. Or you can buy a synthetic ETF where they don't actually own the investments. They generally use swap contracts or derivatives effectively that they purchase from another financial intermediary. And in other parts of the world, interestingly, it's more common for an ETF to be synthetic, to have these sort of, derivative contracts that they use instead of actually buying all the holdings. But here in Canada, more common to buy the underlying holdings directly. So there is an element of risk if the counterparty that Global X uses has some sort of difficulty, repaying the contract or providing the return of the contract. If there was some sort of global financial crisis and, dominoes were toppling and, it led to something, there could be a risk with buying a synthetic ETF like that. I think with Global X, with their Canadian, their TSX 60 ETF, I think they've got about 40% counterparty risk that they list. And I think you could read a little bit more about it on their site. But there's a notional and more than a notional real risk there. If there was some sort of a bank failure or institutional failure, I'd argue that, if we've got banks failing here in Canada, we've got, bigger issues like rioting in the streets. But, it's something for anyone considering a corporate class that has a swap component, something to consider.
Mm-hmm. So the counterparty risk that you see, I have to give a shout out to Mark Soth at the Loonie Doctor. He's done some really good content on this as well and really dived into it. And so for anybody looking to do more reading, that's a really, really good resource. So definitely suggest that. When you talk about and he talks about the counterparty risk as well. And so when you say something like 40%, what does that mean exactly? And at what point should we be concerned that, okay, this is now more than what I signed up for. This is now looking a little scary. Maybe I should just go back to my vanilla, S&P TSX ETF. And, even though it's not going to be as efficient potentially when it comes to things like government benefits, maybe.
My answer, Cornell, I don't know. I don't know how you evaluate or determine, what is the riskiness of that and what's the likelihood of, the counterparty failing. So it's something that causes me to struggle with answering a question on whether or not that's something an investor should worry about. I will refer back to, I mentioned earlier, it's really just for a taxable account. Like you wouldn't, from a tax perspective, in your RSP and your TFSA, it really doesn't matter to the same extent. If you're buying a corporate class investment, you may or may not have another reason to do it. But typically, we're talking about taxable accounts.
Yes.
So for most sort of average Canadians, they might have a little bit of taxable money. They might have a little bit of tax preferred money. So do you have a small exposure in your taxable account? Sure. If you got a huge corporate account, do you go all in on these ETFs and say, I'm not worried about the counterparty risk? I don't know. It's hard to assess and hard to say how much risk is too much, in my opinion, anyways.
Yeah. It's relevant for us because I have the corporate account, so I've got some of that in there, and then as well as the taxable account. But I hear what you're saying. I think the overwhelming majority of the Canadian population, they're focused on maxing out your RSP and TFSA, so they're not even dealing with the taxable account. the non-registered account yet, and probably even fewer have their own corporations as well, right? So yeah, I guess this is a bit of a nuanced topic, but I mean, it is something, especially for retirees, right, where they've been building up their portfolio for years.
Benefit, sure.
Yeah, like RSPs are maxed out, TFSA is maxed out. Now they have money in their taxable account, and they're like, hey, I want to maximize my CPP OAS. Maybe they're eligible for GIS. This becomes a really, really significant thing to have kind of full control when you realize those gains, instead of, again, getting that money in, and then like you talked about before, it gets grossed up, and now you're getting these massive clawbacks potentially. I mean, it can really move the needle in terms of monthly cash flow. So,
for sure.
Yeah.
And the other thing you could do is buy it with a growth strategy. Buy investments that pay lower dividends in certain accounts as well. You can sort of build your own deferred capital gains structure, or do a little bit of both.
Have you guys found, and I realize there could be some nuance here depending on a person's situation, but I mean, broadly speaking, traditionally, the advice is, okay, if your TFSA and RSP are both maxed out, then the next thing is, okay, you can invest in your taxable accounts now. The recommendation that I've seen is, okay, invest in Canadian equities in those accounts because of the dividend tax credit that you get. You know what I mean? So like you have your Canadian equities in your taxable account, and you would have like your US international, let's say, in your other accounts, to kind of split it up that way. But there's that gross up we talked about, where now you're going to get less government benefit. So it's like awesome that we're getting this dividend tax credit in the taxable account now, but you're also going to get less benefits than if you held like a US ETF or some other international ETF. I know when my accountant and when my accountant crunched the numbers for us, the conclusion was, okay, Cornell, for your situation, it still makes sense. Like from an efficiency standpoint, asset location perspective, still makes sense to have your Canadian equities in the taxable account, even though you're going to get the gross up and you're going to get a bit more clawback on the benefits. That was the case for me when he did my numbers using his software. But I don't know if that's like a rule that always applies in every situation. Have you guys run into this where for some clients, it actually made more sense to not have Canadian equities in your taxable account because of the extra clawbacks they were going to get on their benefits? Have you ever run into that?
Not really. I think the advice that you've been given by your accountant is probably what makes sense more or less across the board. I think it would take a pretty unique fact pattern to be any different. I think with non-registered accounts, we're really looking at having two kinds of income show up there from a tax perspective: eligible dividends and capital gains. Eligible dividends and capital gains inside your RSP, for example, there's no benefit to that tax status, right? So we'd rather have the tax benefits of eligible dividends and capital gains fall into a non-registered account, where you then have other more highly taxed forms of income show up, where it is tax deferred in an RSP or tax exempt in a TFSA. So interest, foreign income, rental income, things like that, we would rather have in a tax preferred account, and then have tax preferred income in the non-registered account. So I think that's pretty good advice across the board. Not to say you shouldn't check in on it and just make sure that the math adds up, but typically people making these sorts of investment decisions over time tend to be the ones who accumulate a fair bit and probably don't qualify for government benefits for very long anyways. OAS makes sense, but yeah, I think generally I would view that as pretty solid advice.
Okay, good stuff. Sounds good. Yeah, I'm always trying to be careful not to give sort of these, ironclad, or, this is always the case in every situation for every Canadian, because at least from my experience, a lot of times there are these nuances where, and I would hate for someone to follow some advice, and then it turns out that, it's like, for your situation, you have these different variables, and therefore it actually does not make sense for you. But again, this is why I always say, this is why it makes sense to have an accountant that can crunch these numbers for you, and that you can talk about these kinds of things, and they can crunch the numbers into their software and see, okay, in scenario X, and that's what my account did for me is, okay, if we do this types of ETFs in the taxable account, here's what you're going to pay, here's the benefits you're going to get, versus if you keep it elsewhere. And then we can look at those two scenarios and then make an educated decision from that angle. I was just curious if that was kind of, if my situation was the common one, or if you often actually see exceptions.
And one thing I'd throw in here, when it comes to crunching those numbers, I think as planners, we would encourage people to crunch those numbers over the long term, not just, hey, what does it look like this year? I think one of the big tax planning questions that arises is just where are you accumulating assets and understanding those sorts of implications. So when it comes to testing that question, I think to me, we're not just looking at what does 2025 look like, but if we follow this pattern for the next, say, 25 years, well, what does that look like?
Yeah, I could see that especially, I think those are really wise words. I can see that applying especially to someone that is retired and they're getting into that territory of the mandatory withdrawals from their RRSP, where it's like if you're always optimizing, if you're looking very short term and you're trying to minimize tax every year all the time, and then all of a sudden you hit that age where, okay, now the government's forcing you to convert your RRSP to a RIF, now you have to withdraw that percentage every year. And it's like, well, it can be a pretty big bombshell, right? Where all of a sudden you're forced to take this money out. Now you're in this way higher tax bracket. It's increased, the amount you have to take out is increasing every year. I mean, that can be such a, maybe not catastrophic, but a very expensive mistake for Canadians. So I could see, especially as someone's approaching that.
Yep.
But I guess for younger people too, right? Because I mean, you do want to be able to plan things out as well. Like what's your asset allocation? What should it be as well? I mean, there's so many, it's like it's a lifelong thing, really. Awesome. Paul, quick question for you. If anybody wants to talk to you about the tax side of things, is it okay if they just go through the page we set up for Jason? It's buildwealthcanada.ca/Jason for anybody that doesn't remember. Can they just go through that and speak to you or your team? Things of that nature?
Yeah, for sure. Jason's firm and my firm, we collaborate to assist clients. So certainly we are quite happy to talk to anyone who has questions, and they can use that link to ultimately reach us.
Awesome. And Paul, I heard you're also a financial planner as well, right? Not just an accountant.
That's right.
Not that just being an accountant is bad, but just...
yeah, sometimes. But yeah, I think for me, my CFP was my first designation that I got. I got that a year before I got my accounting designation. Yeah, I work in both worlds. So obviously during tax season, I do a lot of the traditional accounting and tax work to file tax returns and prepare financial statements. But much of the year, I'm working with clients on the planning side. I much prefer looking forward with clients than looking backwards. So I think it's important that we work as planners to say, how can we make clients better off long-term? And that requires looking down the road. And financial planning, I think, really is a great starting point, and it's sort of the all-encompassing view of someone's financial affairs. And the tax and estate planning work that I often get into sort of falls out of that initial look at financial planning. We are that much better able to do our job as tax planners when we have a good sense of what someone's financial plan looks like going forward. So to me, the pieces fit very well together, that we are looking at where clients are heading financially to then know what tools in our tax and estate planning toolbox make sense to consider.
Mm-hmm. Yeah, I think that's so valuable when there is, you can work with someone and they both have that financial planning background and also the accounting background, because if you don't have that, then it's like, okay, I've got a financial planner. You're trying to put them in touch with your accountant. Hopefully they work well together. Hopefully they can communicate. It's like a whole, it's a whole thing. Whereas when it's all kind of in one house, essentially, or within like as a partnership, it's so much nicer, right? Because you have that background as well, but then you've also got Jason and his team. It sounds like a really valuable thing to have, instead of just kind of hoping that the accountant you find and the financial planner you have mesh well together when they're evaluating your finances, and you sort of being that person in the middle, hoping everything works out. So I think it's a really, whenever I see something like that, it's really nice to see, because I think that ultimately makes things a lot easier for really everyone involved, for sure. Yeah, so just for everybody listening, again, I did set up that page where show listeners can get a free introductory consultation with Jason and Paul and their team. If that is something you want to look into, that's over at buildwealthcanada.ca/Jason. So you can go there, put in your email, and then basically they'll get in touch with you. And again, Jason, thanks so much for giving Build Wealth Canada listeners the option to speak to you guys like this, to get that free introductory call, but also to get the discount. So thanks so much for doing that for the listeners for another year. Very appreciated. And again, for everybody, that link again is buildwealthcanada.ca/Jason. buildwealthcanada.ca/Jason. Is there anything else that you guys wanted to add, or now's your chance just as a kind of final goodbye question?
Well, look, I'll chime in and just say thanks again for having myself and another one of my colleagues on, Cornell. It's been, I think I've done this show at least 3 or 4 times, so it's always a pleasure. And yeah, I just can't emphasize enough how important tax and financial planning are. It's definitely the most tax is the most important part of the financial planning work that we do. So tax planning and collaborating with tax planners like Paul is very important. And tax filing, I mean, is just a natural outcome of that tax planning. You got to do whether you like it or not. The tax planning is more fun, but taxes need to get done too. So, but look, thanks for having us and good to chat today.
Wonderful. Thanks so much, Jason. Paul, anything that you wanted to add before we head out?
I'll just say thank you once again from my end as well. I'm always happy to hopefully give clients good information so they can make good decisions and sort out this complicated, messy world of tax.
Awesome. Yeah, thank you so much, guys. And again, I love having you guys on because in that conflict of interest that you get with a lot of financial advisors in Canada where, they're giving you advice and they have a well-crafted sales pitch and that all sounds good, but really then you kind of learn that they're getting compensated on the back end through some investments that they sell or things of that nature. So definitely love having you guys on because I know your information is basically what you found in your research and all the work and the analysis that you do. That's where your advice is coming from, not from some pay structure where, you're going to get more money if you recommend product X instead of product Y. So thanks again, guys, for coming on. Again, buildwealthcanada.ca/Jason is where you can go if you'd like to speak to either of these gentlemen or their team. So thanks again for your help in updating all of us for the year. And until next time. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well. I often get asked what I personally invest in and why. So to answer that, I created an in-depth guide to explain what specific investments my wife and I held and continue to hold as we moved through the accumulation phase, where the focus was to grow our investments as quickly as possible, and then transitioning to living off our investments in our early 30s when we hit our financial independence number, and the focus shifted to living off our investments in a sustainable fashion long-term so that we don't run out of money in our early retirement. These investments are literally where we have almost our entire net worth apart from our house and is what we are living off right now. So I figure at the very least, you'll learn about some great investments to consider for your own portfolio. I explain why I pick those, and I do provide the names and ticker symbols of the specific investments so that you can look them up yourself. The guide is actually a live Google Doc that I continue to update as things change, so you can view it anytime to see what I'm currently holding and why. I get it that it can be super overwhelming with the thousands of ETFs and other investments to choose from for us Canadians, and so I hope this will make things easier and less stressful for you. You can access the live Google Doc at any time by signing up for free over at buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.